In today's episode, we'll break down two important stories. First, we'll talk about the world's investment outlook getting bigger and gloomier, and then we'll talk about whether India can formalize its informal economy. Welcome back to the Daily Brief by Zeruda, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Friday, 10th July. Coming to the first story. So every year, the UN puts out a report that tries to answer one simple question. Where is the world's money going? Here, we aren't talking about stock market flows, but companies building factories in other countries, buying up businesses across borders, funding roads and power plants that they'll be tied to for decades. This year's report just came out and the top line looks great. FDI investment went up 6% in 2025 to $1.6 trillion. After a few brutal years, money seems to be flowing again. Except that number is lying to you a little, or rather, it's hiding a lot. So one example of what's being hidden is that a big company will route billions through a financial hub like Switzerland for tax reasons or to shift cash between its own subsidiaries in different countries. Technically, that money crossed a border, so it counts as investment. But it built no factory and didn't hire anybody. It's just money passing through on its way somewhere else. Economists call these conduit flows, and there's such a big distortion that when the UN strips them out of the global total, that headline 6% growth shrinks to 4%. Now, the report singles out Switzerland and Ireland, some of the world's biggest tax hub, as the two centers that drove most of the difference this year. There are some big, impressive numbers on top and a lot of important nuance buried underneath this 200 plus page report. We'll look at the most important things that stand out to us. So the first thing to understand is that investment went up 6% is an average, and averages hide things. When you split the world into rich countries and poorer ones, the picture splits too. The investment into developed countries like the US and Europe jumped 11%, but on the other hand, investment into developing countries went up 2%. So in a rich country, foreign investment is a bonus. Companies there already have banks, stock markets, and investors lining up to fund them. But in a developing country, foreign investment is often the event. It's how you build roads, power grids, and factories because there just isn't much local capital to do it. Roughly half of all the outside money developing countries get comes from this kind of investment. And it gets worse at the very bottom. The poorest countries in the world pulled in $43 billion between all of them, which is under 3% of the global total. And almost all of it went into digging things out of the ground. Oil, metals, minerals, rather than building anything that could employ people for the long term. So, where is all the money going if not into poorer countries? The answer is technology. In essence, that boils down to AI and, of course, the hardware needed to support it. Memory chips, interconnected semiconductors, critical minerals, and to some degree, clean energy. The report groups these as strategic sectors, and the shift here is dramatic. In 2020, these sectors made up 16% of new investment projects, and by 2025, they were 44%. By now, all of us know that AI runs on giant data centers, and those data centers need land, a reliable supply of huge amounts of electricity, and water to keep the machines from overheating. Only a few countries can host all those things. A stable power grid, water, land, and an entire ecosystem of suppliers and engineers. So this money clusters. The top 3 countries getting strategic sector money grabbed 56% of it between them. Poorer countries don't even have the infrastructure to build a data center in the first place. Meanwhile, the kind of investment that used to help poorer countries grow is drying up. Once you strip out the strategic sectors, the value of new manufacturing projects like textiles, clothes, basic electronics, the ordinary stuff has fallen about 17% over the past several years. For decades, this was the escalator. A poor country offers cheap labor, foreign companies build factories, millions of people get jobs, and slowly the country moves up. But that escalator is slowly going down. The companies that used to chase cheap labor are now chasing chips and data centers, and those don't go into the places that need the jobs. And even who's doing the investing is changing. It's not just Western private firms anymore. State owned companies from China and sovereign wealth funds from the Gulf states are using their national wealth to snap up assets abroad. More than a quarter of the companies on the UN's list of the world's 100 biggest multinationals are now at least partly state owned. That brings us to the second big theme. Governments have stopped sitting back and letting the market decide. In 2025, governments around the world passed 229 rules affecting foreign investment. That's the most ever recorded. For years, the standard playbook was to cut taxes, get out of the way, and let money flow to wherever it made the most sense. But that era is over. Governments are now actively steering where the money goes, and they're doing it in two opposite directions at once, pulling some money in and keeping other money out. So the pulling in part has changed shape. It used to be broad tax cuts for everyone, but now it's targeted cash. Rich countries are handing out massive subsidies, billions of dollars in grants and tax credits, but only to companies that build the things they want, like chip plants and battery factories, and only if they build them at home. The US and the EU are essentially in a bidding war, throwing money at the same handful of tech companies to get them to build locally. But developing countries find it harder to win a bidding war with such an approach. So they're trying something different. Instead of a blank tax holiday that costs them money for a decade, they're tying incentives to results. You get the tax break only if you actually hire local people or transfer some technology or use local suppliers. It's less them begging for investment and more attaching some strings to it. Meanwhile, the keeping out part is growing fast. More and more countries are setting up systems to screen foreign investment for national security reasons, and they've increased their power to review and block a foreign company from buying something sensitive. In 2016, 21 countries had this, and by 2025, it more than doubled to 52. And what's more, the definition of sensitive has ballooned. It used to mean weapons factories and power plants, but now it can even include data centers, AI startups, telecom networks, and lithium mines. But that being said, few deals actually get blocked. But that's almost beside the point. The mere existence of these reviews can make foreign buyers nervous, slow deals down, and rack up legal costs. And the mere existence of these reviews may be a sign of a bigger expansion on what the term sensitive means. Now, there's one more thing worth mentioning because it lands hard on poorer countries. See, old investment treaties often let a foreign company sue a government directly, not in that country's courts, but in an international tribunal if a new law hurts the company's profits. In 2025, companies filed 56 of these lawsuits, and 80% of them were against developing countries. Many involved mining. So when a poor country tries to tighten environmental rules or demand a bigger cut from a mining project, a foreign company can drag it to an arbitration and sue for billions in lost future profit. For 4 decades, companies built their supply chains on one rule: find the cheapest place to make something and ship it wherever it needs to go. And this worked as long as nothing broke. Perhaps that should be changed to if nothing broke. So the last 5 years saw the pandemic, the Suez Canal getting blocked, war in Ukraine, the US and China going after each other with tariffs, and of course, the Strait of Hormuz being choked. It didn't matter anymore how cheap a supply chain was if it was highly fragile. So companies are rebuilding and they're willing to pay a bit more to feel safe. They're moving factories out of countries they see as risky and into friendlier ones or closer to their customers. Now, India is gaining, and so are places like Malaysia and Thailand because of the so called China plus one strategy. But that doesn't mean companies aren't leaving China. Why would you let go of the country where you continue to have the most advantages? Instead, they're building backup factories elsewhere so that in case trade with China gets blocked, they're not stuck. And in all this, the consideration of cheap has gone out the window in place of geopolitical uncertainty. Now, India is a good example of how the headline figure of investments attracted can deceive someone. So the money coming into the country jumped 44% last year to $39 billion. That was one of the biggest jumps anywhere, and it was enough to make us the 11th biggest destination in the world. On its own, that sounds like nothing but good news. But there's a catch. The money going into brand new projects actually fell, dropping from approximately $111 billion the year before to $74 billion. So the money is still coming in, but it's just going to what already exists rather than greenfield projects. So, in summary, the world's investment story is one of developed nations attracting new funds for emerging technologies. But the appetite for old ones is dying, and there's a dearth of greenfield investment in developing and poor nations. Now, a few are pulling it off. Kenya, for instance, generates almost 90% of its electricity from clean sources, and it's using that to attract data centers because companies under pressure to go green will pay to build wherever the power is clean. Indonesia, meanwhile, banned exporting raw nickel ore, forcing battery companies to build processing plants inside the country if they wanted the metal. And it turned itself into a hub instead of just a mine. But these are pockets of leverage that they have. At the same time, investment flows are becoming a lot more siloed with increasing deglobalization. And countries are putting stricter marks on what kinds of foreign investment, or for that matter, imports, they can allow. Now, we've known all of this for a while, but the massive numbers put it in a scarier context. While the $1.6 trillion headline is eye popping, the outlook is pretty glum for most countries trying to play catch up. The world is just investing in fewer places, in fewer things, for reasons that have less to do with growth and more to do with fear. For all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description. Coming to the second story. Picture a small cottage tailor, the sorts with two sewing machines in a rented room, stitching blouses and school uniforms for the neighborhood. It's the kind of business you see in every corner of India, and it takes small pieces of work for small sums of money, creating a job or two in the process. Now, most of India's business activity looks somewhat like this. 9 in every 10 Indian workers work in conditions like this. Only these don't exist in documents, databases, or really in any formal context. To a bank, a tax database, or a labor inspector, they might as well be invisible. And this is one of the perennial problems of India's economy. If you can't see who your economy comprises, you're hamstrung in everything else you might want to do. So this June, Soumya Kanti Ghosh and others at the Prime Minister's Economic Advisory Council came out with an interesting working paper. It has ideas that, while perhaps a tad optimistic, is worth engaging with. They argue that businesses like this are slowly being drawn towards formalization, not completely and not equally in all dimensions, but they're becoming easier to identify, count, and lend to. They're becoming legible. So, what can this legibility do for our economy? And where does it still fall short? For that, let's dive in. The informal economy, if you don't know better, sounds shady, like businesses deliberately kept off books to dodge taxes or do something illicit. But the truth is more banal. This is the part of the business world that isn't yet visible to the rubric of formal systems, and these are ordinary legal businesses carrying out routine transactions. They simply haven't entered the world of registers and record keeping. So our cottage tailor might stitch beautiful blouses and might still lack tax filings, pay slips, or a recorded financial history. And this is surprisingly common all across the world. According to the ILO, 200 crore people, which means 3 in every 5 of the world's workers, earn their living informally. And the picture's even more skewed for India. Most Indian farming, of course, is entirely informal. But even leaving those aside, India's roughly 8 crore informal businesses employ close to 13 crore people. Now, there are serious downsides to the invisibility of this dark economy, both for the businesses themselves and those they employ. So, to a business, the formal economy, above all, opens into the financial system. Banks usually only lend to businesses they can see. So, you need audited books and earnings records to prove that you're a good borrower. But without that, capital, which is the lifeblood of any business, becomes inaccessible. But the bigger downside, arguably, is for the worker. The basic protections a job comes with, like a written contract, paid leave, social security, are all creatures of the formal economy. But the informal economy, in contrast, only comes with gigs, which can disappear without notice. Now, it isn't easy for a business to cross the barrier and become visible, because visibility brings friction and scrutiny. Formality brings paperwork, and in India, a lot of it. You need to register yourself repeatedly with corporate registrars, tax departments, labor departments, and more. You need to handle questions and subject yourself to investigation by everyone from the municipality to licensing authorities. And there are, of course, benefits to crossing this hump. But as the economists Rafael Laporta and Andre Schleifer have argued, not everyone can actually avail them. Our cottage tailor shop, for instance, might just be too small for formality to actually pay for itself. So, why even make the shift? This is the world the paper tries to make sense of using two surveys from 2025: the Periodic Labor Force Survey, or PLFS, which looks at workers, and the Annual Survey of Unincorporated Sector Enterprises, or ASUSE, tracks unincorporated businesses. Now, at first glance, the paper seems to suggest that India's informality problem is only growing. Across three recent rounds of these surveys, the number of unincorporated firms other than farms rose from about 6.5 crore to 7.9 crore. And the number of workers they employ grew as well, from roughly 11 crore to 12.8 crore. As the number of such businesses has grown, so has their role in the economy, from marginally below a tenth of our economic output to marginally above a tenth. Now, from those numbers alone, India's informality seems more severe. But it points to something curious. Somewhere buried in its methodology, the paper introduces the idea that formality isn't a yes or no question. A business doesn't need a full package of legal registrations to become visible. It can register for some things and have a set of records for some purposes without being entirely formal. And then the paper studies unincorporated businesses. That is, businesses that don't run as companies. These could be partnerships, family businesses, shops run by sole proprietors, or follow other configurations. But they could still have some registrations. They could have GST numbers or carry a trade license from their local governments. Over the period the paper looks at, the share of such businesses that have some registration have barely grown. 2 years ago, they were barely under 37%. But now they're closer to 37.5. But those registered firms aren't all equal. In fact, the paper creates a 0 to 100 scale based on how formal they are. And some registrations seem to be overwhelmingly more useful than others. For instance, a firm that has an Udyam or Udyam Assist registration gets almost twice as much financing as those with any other registration. And we'll come to this shortly. Now, more interestingly, there are other ways in which these firms are becoming visible, which have nothing to do with the government. Consider internet use, what has become in our times one of the first traces businesses are leaving behind through QR codes, WhatsApp orders, online payments, and the like. Just 2 years ago, 1/5 of these unincorporated businesses were online, and now that number has nearly doubled to 2/5. Now, beyond this, in our humble view, some of the paper's conclusions are a bit of a reach. But it got us thinking. If there are different levels of formality, what does that tell us? If the government can't push businesses through the full set of compliances, are there side doors that can help them get some benefits? So the government, it turns out, has been thinking on these lines as well. In January 2023, for instance, the Ministry of MSMEs launched the Udyam Assist platform, which runs through the Small Industries Development Bank of India, or SIDBI. This was meant specifically for a class of firms that didn't fit the normal registration route. These firms are too small to cross the regular GST threshold and file no GST returns at all. Ordinarily, most registrations require their own paper trail, but such businesses would usually have none. So, to get around this barrier, the government allowed approved middlemen like banks, NBFCs, microfinance lenders, and even government departments to sign such businesses up and issue a certificate on their behalf. Take our cottage tailor once again. If she needed a loan to renovate her shop, before this, she would have to scramble for proof to carry to the bank counter, rent receipts, a passbook, or whatever, and it might or might not suffice. Udyam Assist replaces that with a single document that the bank must recognize. Now, this doesn't make the establishment formal, but it gives it a narrow slice of legibility which the financial system can act on. And this comes without the costs of formality, registrations, filings, records, making it easier for a small business to take to. It makes it visible to a credit institution specifically without demanding that the business transform itself completely. And there's more. Banks are incentivized structurally to give loans to these entities. Under priority sector lending rules, banks have to reserve a share of its loans to certain specific groups of borrowers, like small businesses or farmers. And these targets have to be hit. Most such borrowers are informal. But now, by government notification and in the Reserve Bank's own rulebook, an Udyam Assist certificate is treated exactly like a full Udyam registration. This legibility, in other words, helps banks as well. Meanwhile, the government has stepped in as a backstop, de-risking the decision to lend to such a firm. Through its credit guarantee fund, it covers 85% of loans of up to rupees 20 lakh with no collateral asked of the borrower. So if things go wrong, this caps what a lender could lose. Now, to scale this, interestingly, the government is leaning on another lever of visibility: the internet. Many small businesses were already networked into online platforms, and the government turned these into a distribution channel. In September 2025, for instance, the payments app PhonePe began letting merchants generate an Udyam Assist certificate inside the app itself. This was then tied into a credit arrangement with Tidbits. So let's look at this from the eyes of our tailor. A UPI app they once signed on to now gives them a slice of visibility, which makes them eligible for loans, all without having turned formal. And Udyam Assist, in just a few short years, has managed outsized success. By July 2026, nearly 3.85 crore firms had signed up through Udyam Assist, alongside almost 9 crore across the full Udyam system. Many of these firms technically lie on the wrong side of the formal-informal divide, but even limited visibility goes a long way in opening doors for them. But as the economists Laporta and Schleifer have noted, being seen helps at the margin, but it doesn't turn a subsistence workshop into a thriving business. Businesses are often informal for a range of reasons, and a single intervention may not help them cross the line. And this is visible in the Udyam experiment as well. While Tidbits had registered nearly 9 crore enterprises by the end of 2025, a much smaller number, just 3.6 crore, had actually taken a loan. Meanwhile, for informal workers, the intervention has done very little. In fact, even among India's regular salaried workers, more than half have no written contract and no social security. Selective visibility hasn't changed their lives. But for all this experiment points to something interesting. The stubborn informality of India's economy can sometimes make it feel like an impossible dead end, a problem so large that nothing can fix it. As it turns out, that's far from the truth. Visibility isn't an all or nothing game, and informal businesses are not static businesses. Making just a single document easy to attain in itself can change the fate of a firm. Now coming to the tidbits. NPCI is developing a Unified Agent Protocol or UAP to register, verify, and authorize AI agents to make UPI payments autonomously pending RBI approval, as UPI hit 22.71 billion monthly transactions worth Rs 28.92 trillion in June 2026. Coming to the next tidbit, the India-UK FTA takes effect July 15th, offering zero duty on 99% of Indian exports. GJEPC projects gem and jewelry exports to rise from $754 million to $2.5 billion, with overall bilateral sector trade reaching $7 billion. Coming to the final tidbit, Dr. Reddy's has delayed commercial supplies of its semaglutide generics sold as Obida, Marshlow, and Olimvic after finding out-of-specification API batches, and the stock fell 5.9%, its steepest drop in 4 months. That's all the news I have for you. Thank you so much for watching, and see you in the next one. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.